Hi everyone, I'm Karan and welcome to Karan's Kyan. The news on focus for today is by Credit Suisse. As you know, Credit Suisse is a very big European bank, and whenever a big bank says gives its opinion about its market views, it should be taken into consideration. And investors do react whenever a big bank comments about a market. So what this bank, Credit Suisse, is commenting, it's saying that Indian equities have a underperform rating. It holds on to its previous rating of underperform. So Credit Suisse gave a previous rating in which it said that Indian equities would underperform, and it still holds on to that rating despite the recent rally in Indian equities lately. So, here are the recommendations. It says that it has given outperform weighting to Taiwan because of its technology and hardware related companies. It prefers Hong Kong and Indonesia on its valuations. Indonesia is about an economy that has been beaten down a bit and should, especially at a consumer level, recover in the second half of the year. It gives underperform weighting to both India and Malaysia. So, Indian and Malaysian equities both have an underperform rating. Expect Singapore equities to perform in line with regional markets as slow recovery and impact of low interest rates offset attractive valuation of the market. So it says that it expects Singapore to perform in line with the regional markets, which are Asian markets like Malaysia, India, Indonesia, and it says that the slow recovery and impact of low interest rates are offsetting. That means they are kind of overcoming the attractive valuation. So it's saying that the attractive valuation is a positive point, but the negativity of slow recovery and impact of low interest rate is making this positive to a zero. This is what offset means. Other key takeaways, the news also gave other news about world economy. So it says Asia, including Japan, are set to Asia excluding Japan stocks are set to outperform other emerging markets in second half of 2020. So as you know, we have already entered the second half of 2020, and and Asia, excluding Japanese stocks, are set to outperform. So all the Asian stocks except Japanese stocks. So what they mean by Asian stock is Taiwan, China, South Korea, and Asian stocks, Hong Kong, but not India, because what European lingo means as Asia means basically the Southeast Asian countries. Basically, that's what Asia for them. Technically, India is also Asia. This is not what they mean. If there is any region that stands to benefit from the beginning of resumption of normal activities in the world economy, Asia stands out because of its export dependence. All right, now try to understand what they're trying to tell here. He's saying that Ray Faris, the bank's chief investment officer of South Asia, he's saying that Asia stands to benefit because of its export dependent economy. Asia is heavily dependent on its exports, and as a result, it is the region that will gain, that will benefit a lot because the industries all over the world are shut down because of the lockdown. And since Asia is opening up, Asia would benefit the most because while the rest of the industries of the world are shut, the Asian industries are up and running and roaring like an engine. With China reopening its economy ahead of others. So, as you know, China has had coronavirus before the other countries, and while other countries are facing a lockdown, China is opening up its cities and it's opening up its industries and is actually reopening its economy ahead of others. Asian economies are expected to be among the first to recover amid billion of billions of dollars of stimulus and easing infection rates and an uptick in consumer spending. So what he's saying that Asian economies would recover because first of all, they're the first to open the export dependent economies. They have got billions of dollars of stimulus from the government. The infection rates are going down. Coronavirus infection rates are not the same as they were before, and the consumers have started to spend again because the lockdown is over and they're out of the houses more. Bright spots have emerged, such as improving Chinese data for consumer demand. So these are good signals. This is what they mean by bright spots. So he's saying the Chinese data for consumer demand and industrial output is like increasing. Consumer demand and industrial output is increasing, as well as shipment data from South Korea this month is also increasing. That means South Korea has started exporting back again. Credit Suisse is betting on further weakening of dollar. Dollar is going to weaken further, which has already depreciated by 2% versus percentage wise versus other 10 major currencies in this year. So other 10 major currencies are yen, Swiss franc, euro, pound, yuan. Improving prospects of global growth and expectations of low interest rate in US through 2022 will all support strengthening Asian currencies. So what he's saying that Asian currencies would again strengthen because of a weakening US dollar. So now let's go and look at the Nifty chart. So Nifty chart. As you can see, today the date is 24th June, and Nifty is down by about 1.5%, and which kind of holds true to Credit Suisse's statement. And as said, when a big bank makes such a statement, it always affects the reaction of the market. So maybe investors are spooked by Credit Suisse's statement.